Okay, as mentioned in previous videos, there are two types of adjusting journal entries that we're talking about. We have deferrals and accruals. In our previous videos, we introduced the idea of AJEs and discussed deferrals. This video is going to focus on accruals. The purpose of accrual adjusting journal entries is to record when revenues or expenses exist in substance, but haven't yet been recorded because the cash timing of those revenues and expenses differ. So this is when revenues and expenses exist in substance, but haven't yet been recorded. Remember, AJEs themselves, both deferrals and accruals, don't involve cash. This is not to say that revenues and expenses don't eventually turn into cash. Many or most do. But this is to say that the AJE itself doesn't involve cash. And so what we're going to be focused on when doing accrual journal entries is situations where we have revenues and expenses, but we haven't yet recorded them because most of our daily journal entries are revolving around cash. Remember, we learned some daily journal entries in Chapter 3 that didn't involve cash. And remember what I told you in a previous video, that some of the journal entries you've already been exposed to are actually AJEs. We just haven't called them that. And so we'll sort of note those as we move along in the chapter. One final item to note before we move into some examples is in contrasting between deferrals and accruals, accruals don't have a previous original journal entry that we're adjusting. Remember that deferrals do. With deferrals, something's been previously postponed to the balance sheet, and our AJE with a deferral AJE removes it from the balance sheet and places something on the income statement. With accruals, that's not the case. With accruals, there is just something that's happened in substance, a revenue or an expense, that we haven't recorded yet at all. So with accruals, we are still adjusting the records to include this revenue and expense, but we are not adjusting previous records in the sense that we are taking something off of a postponement to the balance sheet and placing it on the income statement. Instead, you'll find with accruals, we're increasing something both on the balance sheet and on the income statement. On this first example, we're looking at income taxes that a corporation would pay. So our period's from September 1st to September 30th. During that month of September, we are earning revenue, generating or incurring costs for expenses, and that's producing for us a net income. Remember, a corporation is its own separate entity, so it pays its own income taxes. During that period of time, while we're generating net income, we're not recording that we owe taxes, but in substance, we do owe taxes because they're a necessary part of generating net income. As we generate income, we have to pay taxes on that income. So once we produce financial statements on September 30th, we have to tell the individuals outside of the company, remember, external users are the ones that use financial information. We have to tell them, hey, we've incurred taxes, we've incurred a cost and expense associated with net income. We just haven't recorded it. Remember, accruals are when something in substance exists, a revenue or expense, but it hasn't yet been recorded. So our journal entry as of September 30th for the AJE is to debit income tax expense, increasing an expense, right? Decreasing stockholders' equity. And then we will credit income tax payable, increasing a current liability because we expect to pay those income taxes within the year. Now, notice what's happened here. The expense is an item on the income statement. So something on the income statement has increased. Remember, this is not to say that net income has increased. In fact, as an expense increases, net income goes down. But a component of the income statement has increased. Notice what else has happened. A component of the balance sheet has increased. A liability has increased. So we've increased something on the balance sheet as well. And that's a characteristic of an accrual AJE. It increases something both on the income statement and on the balance sheet, whereas deferral AJEs decrease something on the balance sheet and increase something on the income statement. Notice a second characteristic of an accrual AJE. There is no original journal entry to adjust. Remember, with the deferral AJE, we have something that's previously been postponed to the balance sheet that we're adjusting. Here with an accrual AJE, there is no original journal entry to adjust. We still have to adjust the records, but there's no original journal entry that's been postponed to the balance sheet to adjust. There's just something in substance that exists that we haven't yet recorded. Our first accrual AJE example, match an expense with a liability. In this second example, we're going to match an asset with a revenue. Okay, here we have a situation where a company is earning interest throughout the month of January. During that time period, they are earning interest from, for instance, a loan to another company or an investment in debt security, but they're earning interest throughout this period, but don't yet receive the cash for the interest until March 31st. Remember, if we're preparing financial statements on January 31st, we have to tell the users who are outside the company, not familiar intimately with what's going on with the company, other than what they read through financial statements, we have to tell them that we have earned interest. That journal entry to tell them is the AJE. So we're adjusting our records to show in substance that interest has been earned, even though we haven't recorded anything yet. Our journal entry to show this is debit interest receivable, which is a current asset, and credit interest revenue, which increases the revenue and increases stockholders' equity. Okay, notice what's happened is we are increasing something on the balance sheet, the current asset, and we're increasing something on the income statement, the revenue. This again is a characteristic of an accrual AJE. It will increase something both on the balance sheet and on the income statement. And as we saw previously in our last example, there is no original journal entry that we're trying to adjust. We are simply including something that has existed in economic substance, but we haven't yet recorded. As illustrated above, with accrual AJEs, we are matching assets with revenues and liabilities with expenses. And again, we're not taking something from the balance sheet and moving it to the income statement. We are increasing both the balance sheet or something on the balance sheet and increasing something on the income statement. In attempting to record AJEs, both deferrals and accruals, always ask yourself the question, where are we now? Where do we want to be? In other words, where do we want the records to be? And then right in between there is the AJE that's going to take us there. That is the purpose of adjusting journal entries. It is to take us from where the records currently are to where we want the records to be in consideration of the revenue and expense recognition principles. Deciding between whether or not you should do a deferral AJE or an accrual AJE, you ask yourself the question, is there a previous journal entry where I've postponed a revenue or expense to the balance sheet and I now have to take it off the balance sheet and put it on the income statement? Remember, it'll be sitting on the balance sheet as either a liability or an asset. And we move the assets under a deferral AJE to the income statement as an expense, and we move the liabilities under a deferral AJE to the income statement as a revenue. If you do not have a previous journal entry postponing a revenue or expense to the balance sheet as a liability or asset, then you have an accrual AJE if something in substance still exists and you have not recorded it. So no previous journal entry. We'll say original journal entry. Remember that journal entries exist for all kinds of transactions. So when we're talking about a deferral AJE, it's specifically that you've postponed a revenue as a liability or expense as an asset to the balance sheet, and the deferral AJE is adjusting that specific journal entry. With an accrual AJE, there is no specific journal entry that's postponed a revenue or an expense to the balance sheet. But you can have a related journal entry and it still be an accrual AJE. For instance, if we loaned another company money as a note, we would initially record that transaction as a debit to notes receivable and a credit to cash for loaning the money. But when we do an accrual AJE to record the related interest, the interest revenue and interest receivable that we have, we are not adjusting the original journal entry, which debited notes receivable and credited cash. In that situation, we have a related journal entry, the debit to notes receivable, but we're not adjusting that original journal entry when we record our accrual AJE. We're instead recording a completely new transaction that exists in substance, the occurrence of interest revenue. That now exists, and it's related to the notes receivable, but we're not adjusting the notes receivable account. If we were, it would be a deferral AJE. But since we're not, and we're recording something completely new, the interest, it is an accrual AJE.